Well, good evening, everybody, and welcome to Wook Capital Management's third rendition of our Wook Book Club. This month, we're going to be discussing The Psychology of Money by Morgan Housel. Before we get into the discussion, I just want to get a disclaimer out of the way. Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results, and all investment decisions of an individual remain the specific responsibility of that individual. Okay, with that mouthful out of the way, I'm glad to see I have most of my team here on the panel. We're going to, Joe, I see, has got the thread that we posted earlier today pinned here. So I think we will kind of go a little bit from topic to topic in the book. The book broke down each kind of topic into chapters. There were 18 chapters. We're not going to get through all of those chapters. Just for expectations, I expect we'll have the conversation wrap by the 2 hour mark. So at latest 10 o'clock Eastern time. And yeah, look, we're going to have this conversation between our team. We absolutely welcome and hope to have some input and discussion from folks who are not a member of our team. But if you're just looking to sit back, relax, and enjoy the show, please do so. And of course, this is being recorded and it will be available on our Wook Capital YouTube after the fact. So with that mouthful out of the way, yeah, let's get started talking about the psychology of money. Let's see. So I'm looking at the order of how this thread was posted. Joe, do you know which chapter is which? I don't want to jump around too much from the thread so that we can keep it easy for people to follow along here.
Well, we can jump around the threads, and I'll just pin whichever topic. I'd say it would probably best to go by chapter number versus what the threads were.
Okay. All right. Sure. Then I'll start off, and if anyone on the team wants to skip around to a different chapter after we start, I think that's fine. So I'll start in the logical starting place. I'll start with chapter one. Let's spend a few minutes talking about chapter one, titled "No One's Crazy," and then yeah, please, whomever on the team or in the audience wants to take us to the next chapter, please chime in after we wrap. So no one's crazy. The book starts out with I think we take for granted how impactful our own life experience is. We under consider maybe how impactful our own life experience is, and Housel really makes that point in this chapter that yeah, your lived experience is such a very narrow set of uh, of outcomes and decisions and the like. And you should be careful with assuming that other people, because they're doing things that don't align with your own thinking. And I know I find myself guilty of this personally. Obviously, this is Rod speaking, and I have my personal account joined as a listener right now. But you see people making decisions that you may find as to be irrational or crazy, but you should probably step back and realize there's a reason that other person is making that decision. There's a quote in the chapter, quote, "In theory, people should make investment decisions based off their goals and the characteristics of the investment options available to them at the time, but that's not what people do. The economists found that people's lifetime investment decisions are heavily anchored to the experiences those investors had in their own generation. especially experiences early in their adult life. So I guess a prompt question I had written down was, uh, what are some things you've seen other people do that seem crazy to you that are a byproduct, or maybe a byproduct of their lived experiences relative to yours?
This is JP over here. It's not my experience, but one of the examples that I really liked, that he mentioned in the book is about the lottery tickets, how the poorest Americans and the bottom 10% of the people who purchase lottery tickets, they're like, most of us will think it's a very stupid decision. It's not a very economically smart decision to make. But at the same time, like, we can understand why somebody would buy that at the lowest socioeconomical status. People just don't have money, and it's the one time that they can actually have hope and think about how, like, be somewhat, feel like they can get out of their current situation. And it may not be rationally a good decision, but we can understand why they would feel that way and why they would purchase it. And he kind of talks about how we should think about it from both angles. Like, oh, that person might do it, and I will invest in something that may not turn out to be the greatest investment, but I have my preconception, and my brain is engineered in a way where at that moment I thought it was a great decision and it didn't turn out well. Don't beat yourself over it so much, right? To a point where psychologically you've really, you think you suck, right? So I thought that was very comforting. I think that's something that we should all have as investors, and being able to not judge other people, and that'll also give that peace of mind for yourself when you're investing, even when you make the wrong decision.
That's a good point. The the reality is that buying a Powerball ticket isn't all that much different than buying some crazy out of the money call option, right? Or put option, or uh, whatever your commensurate item is. And if that's like the thinking you've been raised, that it's all very much, outcomes are very much driven by chance, and that's your one shot to make it happen. I think that might be a corollary of the type of behavior, that might be an embodiment of.
And I think that also kind of correlates with chapter 11. I like chapter 1, but I also like it's a good segue to chapter 11, although they're 10 chapters apart, but kind of talks about rational versus reasonable. So, um, but I won't go too deep into chapter 11 just yet, but I think they go kind of hand in hand, because it's not always about making the rational decision. Buying a lottery ticket isn't a rational thing to do, but you can see how that could be reasonable, and you can kind of see, well, you can kind of understand why somebody would do that, right? So um I thought those two chapters were pretty similar. And yeah.
Right. I think in yeah, both in chapter one and chapter 11, like the main focus is that um, people's decision making is influenced by people's psychology and other factors that influence their thinking, rather than like their logical, like their ability to make logical decisions, rational decisions, like you said, JP. Um, but yeah, it's just interesting. This book for me. Gave me a new perspective on thinking about the behavior of money, because you know money is representation of resources, and people are people spend these resources, and inevitably how people think is going to impact how money moves around a lot. And in chapter one, I love how you know, Housel kind of sets the tone for the rest of the book by giving all these examples of people thinking completely different ways when they think about money, but digging into the reasons behind that. For example, there's this chart, but I'm not sure if we can get this up on Twitter, but the chart shows what inflation did to prices in your teens and 20s. Essentially, this shows two different groups of people. People who are born in 1960s and people who are born in 1990s, and comparing how their lives have been impacted by inflation over the first 28 years of their lives. And this is something that kind of sheds a light on something that I believe we're all familiar with. Like when we talk about money with our parents or generation above, there are always disagreements, right? They're always their approach to money, they're thinking about savings and investing can be completely different from the way as me. I was born in 1993, and it's very different from the way I think. And it's interesting because we're now, in the era where inflation is super high, and it'll be like we will have noticeable difference in opinion between like the way we as in people born in 1990s think about money versus the way the kids these days think about money later on in their lives. So it's kind of a ongoing cycle, and at the foundation of it all, it's the most important to to try to be less judgmental when observing and thinking about the investment approaches that other people take.
Yeah, look, if you grew up in the Great Depression, your thinking is inherently going to be a hell of a lot different than somebody who grew up in only boom times, right? I think that's in essence, you know, I guess it's kind of an extreme example though of what Housel's trying to get across in this chapter, that your lived experience greatly informs how you think about money and the decisions you make with money, and especially at an earlier age. I'm of my team. I think I'm the oldest on my team. I'm born in the '80s. I'm born in '89. I was an undergrad during the Great Financial Crisis. I graduated undergrad in 2010. So while I got to see that somewhat, my experience is far different than even someone who graduated just a year or two before me, graduating right into the teeth of it and having to get into that job market, finding how challenging that job market was. So that perhaps their level of risk taking might forever be somewhat diminished relative to someone who didn't graduate into that environment. I think it's hard to ignore the true fact that our lived experiences greatly inform how we act, and I think that's the point Housel's trying to make here in the opening chapter of the book.
Right. I mean, I definitely relate to, even just by a few years apart, things can change a lot. When I was in college, people who were just a few years ahead of me, were getting jobs in Wall Street super easily. It was kind of a no-brainer that they would just get an investment banking job in Wall Street without trying that much. There was not much competition, not much, worry about the future or like an initiative to prepare and save. But that changed drastically within 5 years, and it just shows how our lived experience can really like permanently alter the way we think about money, the way we think about our spending, the risk that we take. So the best thing we can do in this scenario is to recognize that even a few years of lived experience can change the course of our investing lives, and making sure that we stay humble and keep reading and keep understanding other people's perspectives and trying to learn as much as possible and get closer to the truth.
We had a couple folks come up outside the Wook team to be a speaker, and you guys are welcome again to chime in whenever you want. If anybody in the audience wants to come up and speak on any of the chapters or the book or topics related to the book, please feel free. This is we have our only constraints. We're trying to keep it largely confined to the topics within the book, but we'll go where the conversation takes us. JP, assuming no one else wants to chime in on one, I like 11 because I had written down in my notes specifically to push back hard on this one because I am a very rational person, and
Mm-hmm.
I what reasonable over rational for me doesn't work. It wouldn't work for me.
Yeah, yeah. No, I was thinking the same thing because this is my favorite chapter, chapter 11. Yeah, because one of the examples that he goes into is talking about syphilis, right? As you guys probably already read, what he talks about is before antibiotics came about, they had syphilis, and the way that they got rid of syphilis back in the day was to inject a very weak strain of malaria, because what that did was that would create fever in the body, and the fever in the body would kill off the syphilis. Now, if that was the case, fever is technically a very good thing. Fever is something that's pretty much just a reaction from the body that it's fighting off this infection. But yet, people will take medicine to alleviate the pain and to mitigate the pain as much as possible and mitigate the the fever, right? Then why are you? That's not a very rational thing to do. The fever is a good thing. That's exactly what's actually fighting off the infection. So why would you do anything like that? Well, it hurts. Well, just because it hurts, you're just going to take medicine and prolong the infection that's in your body? Like, to me, that doesn't make sense, which is exactly the reason why when we were in Vegas and I was sick, I refused to take medicine, right? So, like, I think if it rationally makes sense and in the long run, if it helps you, you do it. I don't care about reasonable, right? I don't care to take that medicine. Oh, it doesn't hurt. I feel less pain for 3 days. Who cares? I'm trying to get rid of the sickness, fever, bring it on, and then we'll move forward.
Right. Well, JP, I'm gonna disagree with you on this and encourage you to take meds. But yeah, that example in the book is super interesting. Actually, before we dive into the details, I want to first kind of explain what we mean by when we say reasonable versus rational. So using that example, so. And I think the main issue is that as an individual, we always strive to be rational investors, always make logical, data driven, spreadsheet driven kind of sophisticated decisions is what we all try to go for. But investing inherently is the game of understanding how the mass will behave and you know understanding that the mass will behave more reasonably than rationally, meaning that these people experience pain and they experience joy when they make a lot of money. That will change their thinking psychologically. And as the examples in the book says, people get sick, but then they want to get better. Exactly like what you said, JP. They want to feel better. And even though they understand that having the fever will be beneficial for them in beating this disease, they go to the doctor, they take Tylenol to feel better. So I think, kind of accepting the fact that humans in general, the market in general, will always feel the pain and joy of investing, and that is going to impact the way market behaves, is an important lesson from this chapter.
Well, I'm going to push back a little bit on that statement because I think, yes, you're right. It's one thing to recognize the fact that other people are more reasonable than maybe rational, because there's a saying, right? Personal finance is more personal than finance. But understanding that is also rational, and how the mass will behave, that to me is a separate issue compared to me acting in a way that's rational versus being reasonable, right?
Well, the
So,
sentence that I bolded in my notes is the most sound strategy is one you can maintain, right? So that to that
true.
exact point, if you cannot maintain a hardcore, hyper rational, whatever you want to call it, approach, then you need to settle for, and you need to identify what would be reasonable for you, because I might be willing to tolerate an 80% drawdown, but many other people may find themselves incapable of tolerating that, and they may find themselves selling, at the low, whatever. So it definitely involves a lot of knowing thyself, I think, and knowing what works for me may not work for somebody else. Kind of dovetailing with chapter one.
I think O'Hare
Um,
wants to chime
yeah,
in.
O'Hare, go ahead, bud.
Yeah, you can unmute yourself.
Hey, what's going on, guys?
Hey.
Like like the conversation here. I'm just at the gym working out on the treadmill listening to you guys. I'm hopping in and out of different spaces, and I found one I like here. So I like the
Nice.
topic. I have not read the book, although I have read many books on the topic. I haven't read his. I'll probably end up ordering it. It sounds like a pretty interesting read. A couple of things you guys touched on. The mentality of lottery buyers and the zero DTE or option crowd, maybe not even zero DTE, but the option guys of the last couple of years. I would say it's a good analogy, but it's not a fair one because with lotto, with buying a lotto ticket, right? It's all just a straight up, gamble, right? With options, there's a lot of research you can do to put the odds on your side, right? Unless you're just randomly picking different contracts of different issuers, then you're just straight up gambling like the lotto. But, there's a lot of thought that goes into, at least for me and some of the people I know that trade options, you want to put the odds on your side. So while there's an element of the unknown, right? We don't know if Catalyst is going to happen. If you put some work into, your strategy, you can put the odds on your side to favor, a better outcome. So that's number one. Number two, you guys talked about, one of you guys said you were born in 93. I was in high school in 93. And I remember I was a senior. I remember minimum wage at the time, because I think somebody made the statement of inflation's really, really high right now. I would say inflation's not high. I would say inflation's just normal. It's been normal. It's normalized over multiple decades, right? It's not a linear thing. We've been living in a world over the last 15 years that's really kind of a Frankenstein market. And so, if you're young, and it's not your fault you're young. I wish I was younger. I'm 47. You haven't lived long enough to kind of see multiple market cycles, right? And that's okay. I think this is a great opportunity for young people. Absolutely fantastic opportunity. It's like when I was getting into the business in the kind of the late 90s. You had the tech boom, very similar to what was going on just a couple of years ago. Everything was going up. I mean, literally everything was going up. You couldn't shake enough sticks at things. I mean, you could be the dumbest dude on earth and still make money in the stock market. I mean, without any effort. And then all of a sudden it changed on a dime, and it became a kind of an expert's playground for the next 5-6 years. And so, up until 2007, and then of course we had the financial crisis and the meltdown in credit. So I would say this is a really good opportunity for young people. The times are never perfect. I would rather get into start a career like you guys in a very kind of tumultuous time, rather than in a time where things are just bottomed and moving up. Imagine having started your career in 2011, right? So you really had no idea, had no experience of like the previous 3 or 4 years. You're in 2011, 2012. You're 21 years old, 22. You're just getting going, and then you see nothing but up markets for 12, 13 years. So that gives you a very different perspective. And so, when I was in high school, when you were born, I think minimum wage at the time was $3.75 an hour, and it went to $4.25 an hour. So the reason I bring that up is most places now, federal minimum wage is less, but most places are paying $15 to $18 an hour. When I started working, I was making $3.75 an hour. Yes, gas was 99 cents a gallon. Yes, you can get a one-bedroom apartment for, $400 a month. I mean, you have inflation, but you also have higher incomes than you did when I was, a young man. When I was, 18, 19 years old, just starting out, 20 years old. So everything's kind of in context. You got to take everything from a relative standpoint. You know what I mean? So anyway, I would just say I like the conversation. I think it's timely, and I think you guys are on the right track. I would be very optimistic if I were you guys. There's a lot of good things are going to happen, even though we may go into a. Go ahead.
No, I was gonna say I want to let Ape Fungus. He's got his hands up, but I wanted to kind of
Sure. Yeah.
chime in with a thought from chapter 4 in line with what you just said. The most important thing is to start as early as possible on this. And
Right.
if you're in your 20s, that's great. You're already ahead of the game. If you're in your
Yeah.
30s,
Absolutely.
even that's great. But the key is to start right. In chapter
It's
4,
never too late
not
to
to go into
start, by the way.
detail, is that Warren Buffett started reading about investing when he was 6 years old, whatever. He started investing way early, but the moral of that story is that compound interest and outperformance is what drove the vast majority of his wealth creation because most of it came
Yep.
after he's already an older
Right.
man. So,
Yep. And
hey,
I'll
yeah,
just add one thing to that real quick, and that is, it's never too late to start investing for your future. Even if you're a 50-year-old guy and you're in this space, and you're kind of worried, you haven't been saving enough, you've been paying a lot of bills. Listen, it's never too late. The day you start is the best day, right? So start tomorrow. Put a little bit of money aside. Stop spending money on stupid shit. Budget out your life and start putting some money into some investments. Whether it's an S&P 500 fund like an ETF, just start small, build it up. Over the next 10, 15 years, you're going to be okay. You're going to have more money than you do today. So it's never too late.
Awesome.
hey Ape, you're welcome to go ahead. I know you had your hand up.
Yeah, I just wanted to chime in and say that everyone's experiences with money are so far distorted and from what should actually be because of 1913 and 1970. So ever since the formation of the Federal Reserve and the separation of the gold standard, that's where people's experiences with money start to really skew away from reality. S- And so I I forget what I was trying to tie to. I was listening to O'Hare talk and just talking about inflation and how everybody has their own experiences of inflation. That no human being should ever experience inflation because of fiat money. This is the very first, and it's not cyclical. This is the very first time we have been in a totally fiat money system. So this is a first and for a human experience.
Well, actually, I would say we've had fiat money for centuries, just in different forms. It comes and goes. We had it in this country in the 1800s. So it just depends on the time. Um, I, and I'm not sure I would agree with it's a problem with fiat money necessarily. Um, the thing about fiat is it allows for expansion of the economy. If you're in a hard money system, you have slower growth. You have more concentrated wealth, as opposed to a system that we're on currently. Now, I don't think I don't think there's a perfect system. I don't think a hard money system is a perfect system, and I don't think fiat is a perfect system. I think, you know, it depends on the time, depends on what's going on around us, whether you're in wars, recessions. I mean, there's a lot of variables. It gets very complicated. So just saying that hard money is the best thing, or fiat money is the best thing. I mean, I don't think there is a best thing. I think there's a time and place for everything. And I think regardless if we're in a gold standard, I'm a gold guy. I invest in gold, but I'm also not a gold bug, and that's all I invest in, right? I invest in other things. So one of the things that's wonderful about investing in stocks and equities and real estate and other aspects is that with inflation, you get capital growth. Without inflation, it's very difficult. And so, as long as your capital growth is higher, the expected return is higher than the rate of inflation, you're going to be just fine. So that's the key. Key is to find good investments. They're going to generate good cash flows buying them at reasonable prices. And then to Rod's point, an 80, I think what you said, Rod, was you can stomach an 80% drawdown and somebody else may not be able to stomach that. That's absolutely true. However, I want to avoid 80% drawdowns. I just tweeted today, Novavax. Novavax was a $300 stock 2 years ago. Okay, imagine having bought that stock at 300. Many people did at 250, at 200, and 150. A lot of people bought it at 150 thinking it was half price. that stock today after hours is trading at $6 or whatever it was last I looked. So the reality is, I want to own stuff that, that's going to, and it's hard because then the question becomes, how do you avoid those 80% drawdowns, 95% drawdowns? I mean, that's really the question. So I think that the best answer I can give is to be a value investor, right? Because if you're a growth investor, those are the types of drawdowns you
Yeah,
can
if
experience.
you want to hear stuff, we had Margin of Safety as our last book club. So
Oh, that's a
in
great
that
one.
exact
Absolutely
in that
fantastic.
exact
Absolutely.
vein,
Yeah.
with what O'Hare's
That
talking
does a
about,
great,
investing with a
that does a
margin of
great job.
safety is the best way to prevent those big drawdowns. You're
Exactly.
welcome to check it out on our YouTube, Wook
Yep.
Capital. We've got our second book club if you want to catch the replay there.
Fantastic book. Fantastic book. Yep.
So let me switch the conversation then to chapter 2, which I thought was a really good one, and it really emphasizes luck and the role that luck plays in our lives, just existing as human beings. Like, I'm inherently lucky to have been born into, a two-parent household in Long Island, New York, in 1989, as opposed to being born in uh, some far-flung region of the world where running water is a luxury. In the chapter, that Housel uses the example of Bill Gates, right? He was not only born in the right place in the right time, but he had access to resources that just a handful of people on Earth did at that point in time, right? He went to one of the few schools in the world that had a computer in those years, and he had a unique competitive advantage, which is not to take away what he accomplished in his career or other people like Bill Gates, but that there's a huge degree of sheer luck and fortune. So chapter 2, the title is Luck and Risk. So I would guess, like, pose the question to kind of bounce around, what are maybe some examples where luck has played a big role in either your life or your investing journey?
I think, listen, this is a topic we cover a lot in my spaces. I mean, this idea of luck, right? It's and I think I tweeted about this the other day. It's the unquantifiable, right? It's something you can't measure it, right? It just is. And so there's an old saying, right? I mean, you got to put yourself, right? You got to be persistent and put yourself in a position that when your hard work and effort crosses the path of luck and they meet, you can capitalize. And unfortunately, I think that for most people, they give up too early. I think they give up right before they hit that luck, right? You create your own luck through life. And you're right, there are certain things you can't, I was born in a communist country. I immigrated here with my parents. I had a different experience growing up than many of you. That was my luck. My luck was different than your luck. I could have been born in Sudan or the Congo, right? Or El Salvador or China. You kind of, certain things obviously you can't control, but the things that you can control is your effort, right? Your education, whether you go to a college, university, or self-taught, perseverance, stick-to-itiveness, not giving up. Too many people give up. That's really the problem. I go to the gym, 3 or 4 days a week, and I see people come in and I see the same faces, but then I see them disappear over time. And what that tells me is they just give up, right? For whatever reason, they just stop going to the gym. Same thing in investing, right? People get into some investment and they want quick hit. They need that. They see everybody else getting rich on Twitter and they think, well, I can do that. And, while you can get lucky, and like we talked about the lotto tickets and the options and things like that, listen, I'm a big proponent of investing and trading, right? Those are two distinctly different things. Investing for the long term, trading for the short term opportunity sets, right? If you're so inclined to do, I would say most people are not either capable or they don't have the temperament to trade. It's a unique thing, as you guys know, right? I mean, 2021 was an example, and 2022 was a completely mirror opposite of 2021, right? So trading is not easy. Long-term investing makes things a lot easier, So stick with it, buy good companies, make good decisions, right? And you'll get lucky, And like you said, Rod, the compounding effect over time, right? You compound those returns over time. That's the beautiful thing. What did Einstein say? Compound interest is like the seventh wonder of the world or something like that. you know, interest on top of interest. So, like I said, if you're a 50-year-old guy, start investing, make some good, put some money away with that compounding effect over time. And 15 years from now, when you're 65, you're going to be in good shape, right? You may
Yeah,
not have,
the example from, I'm sure a lot of folks in here might have read the Warren Buffett letter this weekend, but the example being that the amount that Berkshire invested in Coca-Cola is less than the amount that they are now receiving in annual dividends from Coca-Cola, a couple decades later. So just the sheer
100%,
power
100%.
of that. But I mean, just to refocus the conversation on like the luck and risk, I'll read a couple quotes from Housel, and basically he makes the point that quote the line between inspiringly bold and foolishly reckless can be a millimeter thick and only visible with hindsight. Risk and luck are doppelgangers. And then another line is that therefore you should focus less on specific individuals and case studies and more on broad patterns. So I
100%. I would 100% agree with that. That's a great way to put it. Absolutely.
Yeah. So, Abe, I know you have your hand up, so please go ahead.
About 0 day expiries, since everybody keeps talking about 0 day expiries. O'Hare keeps telling people to stay away from them. And not even just him, most of the financial community tells people that these are the riskiest and the stupidest bets to make. When in fact, if you're playing at the money, the risk reward calculation, they have the most to gain if you're scalping these. Like we're saying, make your own success. If you dial in on a 1 to 5 minute chart and play the bounces, there are insane amounts of monies to be made at the money 0 day expiries. So I encourage people to watch simultaneously calls and puts at the money on 0 day expiries while watching the underlying, and you will be amazed. And that is how these people have steady cash flow. They're not value investors. They're just playing the trade,
I think the
you
stat is
know?
what 95% of day traders lose money. I mean, sure, there's plenty of upside to be realized. You're absolutely right. You can make 10, 20, 30 plus X your money if things move the right way for you, but you could also wipe out your principal entirely. So I think that's
Yeah.
where the distinction between trading and investing, with investing, right?
Well,
Rule number one, don't lose any money. Rule number two, don't forget rule number one.
right.
Whereas, you could obviously take different types of risk with a
Yeah.
speculation like that, but they're just very different ends of the spectrum.
Yeah, I would add to that saying, I'm not saying you shouldn't do anything. I'm saying that it's, to Rod's point, it's extremely difficult to be profitable long term. Yes, people do get lucky. You could have let me give you an
Right.
example of, I play a lot of poker. I can go months and months and months having really good sessions, and I think I'm on top of the world and I'm the best player in the world. And then I can go months and months and months with losing sessions, and I just feel like I've lost my edge. I just can't play this game anymore. That's just part and parcel with the game. That's just part and parcel with trading. Um, Zero DTE stuff, I tend to stay away from, mainly because it just requires a lot of, I got to be watching the screen. I got to be watching every tick. I got to be watching every candle. I don't have the time to do that. I do play with options quite frequently. I mean, I have options on right now, but I do more of like opportunistic kind of special situations where I'll go out a month. I'll give myself, 4 to 6 weeks, and I'll roll those options. Most oftentimes I'm wrong, and those options expire worthless, and I'm okay with that. But I'm buying options on situations and around situations that I think could have some interesting catalysts. So there's a difference between
So,
those two strategies, I think.
right. While retail is buying that far out, market makers and hedge funds, they're buying those 0 day till X at the money. Like I said, and like Wook was saying, as long you keep bidding
You're
I can't
breaking
hear you,
up.
Abe.
right,
You're breaking up.
Abe, I would say this. You're right. There's a lot of hedge funds out there that are trading a lot of these things. Now, the thing is, they're trading them mechanically. So they'll run algos. They have a team of, mathematicians and computer scientists and technicians. They'll be able to kind of program, a whole server room and run a bunch of different complicated algos to kind of scalp, very, very quickly inefficiencies in the market. Now, if you can do that at home, by all means do it. I just don't think most people are equipped to do that. So I have done some intraday trading from time to time, very rarely, and I've been successful at it sometimes, and I've been steamrolled sometimes. So it's really a crapshoot,
Yeah.
Oftentimes
So
when I
that's why risk management is
what does
everything.
that
As
mean?
long as
Let me ask you, what does risk management mean to you?
position sizing,
Okay,
so never being all, only having one piece on a trade at all times. Never want to be all in.
right.
But,
Okay, I agree with that.
yeah, that as long as you have that approach, and you're like I said, you want to watch a 1 to 5 minute chart,
Sure.
and if you run a wave trend channel, which is a script, you can literally watch the thing sit there and
Let me
bounce
tell you.
on
Yeah,
that channel
let me tell you.
like
Yeah,
clockwork.
and listen, if that works for you, that's fantastic. Um,
Yeah.
as far as trading is concerned, what's worked for me over the years, and I've been doing this a long time, is more of a longer term swing trading with options and equities.
Hmm.
So I give myself usually 4 to 6 weeks in and around, for example, earnings. That's a great window. That's a big catalyst in and around earnings for me.
Earning
So, um,
earning
so,
huge.
but also,
So
also, also around special situations where companies' stocks are at multi-year lows for various reasons, or multi-year, or really just kind of off the charts parabolic moves to the upside for various reasons. And so those are the opportunities kind of that I look for, and I give myself multiple week time spans. And most oftentimes I'm wrong. So I'm willing to be wrong 9 out of 10 times. Okay.
Yeah.
I'm willing to be wrong nine
So
out of 10 times. But listen, the one time out of 10 that I'm right, I'm really, 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 really right. It pays for those 10 times 10. So what I'm saying is I expect going into what I'm doing to be wrong most of the time. But I know that one out of those times I'm going to be very right. And there's a few things you can do to kind of allow for a more precise targeting of certain situations, as opposed to just kind of like ad hoc. One day I'm trading SPY minis, next day I'm trading Qs, tomorrow I'm trading AMC. That type of a strategy. I really hone in on a handful of things that I really, really understand, and then I trade around those. So I'm just saying,
so I'm gonna
for
bring the
example,
conversation back to the book because I don't really want to talk about the ins and outs of how people oh look, we could talk about that in another space. Just to bring it back to the question, right, that I posed, I'll share an example for me personally where luck played a major role in my investment journey. So, as many of you probably know, I was invested in GameStop for many years. I was somewhat obsessed with it. I put a website together with some friends. I wrote the guy who's currently the chairman a letter, yada yada yada. But here's something I did that was very much luck to the downside. I had data that informed me from the crowdsourced research that I was doing with others at the time that the GameStop holiday sales were going to be quite poor in January of 2021, in early January of 2021, and they ended up being quite poor. But to O'Hare's kind of poker example point, sometimes something comes out on the flop that you had no way to anticipate. Your 7-2 offsuit could somehow become a straight. But I had expected poor holiday sales.
more
The
likely to
data
become a full
showed,
house,
yeah,
full house.
yeah, I guess full house would be even better. I expected holiday sales to be poor. They were, but the same day Ryan Cohen settled with the company, and the stock, 2 days later doubled, and then the rest is history. And unfortunately for me, I had taken my call options off of the table at that point in time because the data showed what I expected to be a poor performance. Something happened, right? That luck aspect happened, and unfortunately, I forsook 5+ million in gains. You live, but for me, that was a pretty major example, and I won't say I'm upset because I still was happy with the end result of that whole thing. But it just goes to show you can have what you think is the right information and act accordingly, and an outcome can still something comes out from the external that you didn't anticipate. That's my example. I don't know if anybody else has a good maybe example of luck that hurt them or helped them.
What was
Um,
Rod? Oh,
yeah, go on.
sorry, Rod. Rod? Explain again. I was listening, but I kind of lost track of that. I'm trying to change settings on my treadmill here. Explain again what happened, kind of in that situation. That's a very unique situation. I'm interested in hearing about it.
Well, yeah, so I uncovered in like November of 20 that GameStop.com order numbers were sequentially numbered. So I spent a lot of time exhaustively on Twitter and StockTwits gathering up crowdsourced data to try and understand how their e-commerce results were going. I put together a rudimentary model that I published on StockTwits and Twitter, showing what I anticipated the quarterly result would be based on e-commerce sales results and based on mix of e-commerce to total sales. So that data showed me that they would have a poor operating result when they were going to report holiday sales in roughly Jan 10th or 11th. So I had a bunch of call options that I anticipated taking off just to rebuy lower, right? Just because I thought the stock would react negatively to holiday sales. I would be able to re-enter my calls at a more attractive price point and avoid that haircut. But at the same time that they would have released holiday sales, instead they announced this surprise settlement with Ryan Cohen, RC Ventures, where he would basically get 3 board seats, which I don't think anyone was really anticipating. There had been a proxy fight in the prior year, and it had seemed like it was shaping up for there to be a repeat of that. But yeah, that I sold all of my calls for the most part off. I still had some spreads and, of course, stock, so I still profited in the 7 digits. But I gave up a lot of opportunity cost, if you will.
Yeah. So listen, that was not a mistake. That was just that was.
No,
that
it
was
wasn't a
prudence.
mistake, but it was luck.
That was prudence. I wouldn't say it's luck either, dude. Listen,
It was bad
we've
luck.
had this.
It was
Well,
bad luck. It is. That's
listen.
purely the
I
example
don't
I'm
think you should
giving.
look at it that way. I don't think you should look at it that way. I think you were doing the prudent thing at the time. Remember,
I was.
you're only listen when you're investing like you were. You're only investing with the information you have today, right? You have no idea what information is going to come out tomorrow unless you have inside information, and so therefore, what you were doing, you
Right.
were
It
acting
was the
imprudent.
prudent thing. I agree. It was
That's
just
right.
unlucky.
That's right. That's right. And
just
I
like
was.
just like flopping trip aces with a pair of pocket aces, and then
That's right.
somebody runners you in poker, right?
That's right.
Bad
That's
luck
right.
happens, but
And
you made the
I
best
was.
decision with the available information to you.
That's
I
correct.
agree.
So that's the way I would look at it for you. And I was intimately involved at the same time. There was, I think, several, maybe a dozen people like us out there, that were involved in GameStop at the time. I think most people in GameStop actually lost money, which is kind of sad. Some people made a lot of money. A lot of people got involved way too late, as is always the case, and got and just got crucified. So, by the way, your seven deuce example of hitting a straight for everybody in the space. If you're playing poker and you hit a straight with 7 deuce, throw your hand away. You're probably going to lose. Okay, you do not want to be hitting straights with 7 deuce. Okay, so I would just say if you're going to play 7 deuce, you want to be hitting something like a full house or trips or something like that. Never a straight.
All right, cool. Let's move on with the topic of the book, Rod. But that actually is interesting. The point about, like, I know O'Hara kind of talked about it earlier. Like, you don't have to win every single pick. You just need to, the one thing that you did get right. You just want to make more than what you've lost through all the other picks that you've made the bad decision in. I think they talk about that in the book. And what chapter was that? Do you guys remember? Chapter 6. Hello?
Yeah, I haven't read the book, but I plan on getting this book. But to that point, I would say, oftentimes what I hear people say, and through conversation on Twitter and just in my daily life, I've been on Wall Street for a long time, is people generally, if something doesn't work out the first or second time, they generally won't go third time. And as a value investor, and this is what, going back to what Rod was saying, his example with GameStop, that was a deep value situation. It was a very unique situation at the time. And, unfortunately, he got out a little early. I think a lot of people got out early. I think most people ended up losing money on GameStop. A few people made money. Lucky for him, he made a lot of money. And and that was he got paid for doing all that work, all that due diligence, all that
I,
research,
I
and so
also had to experience an 84% drawdown from my initial
exactly,
entry. So
that's exactly
I
right,
was very
and so
early.
right, exactly, and I was there with you, brother. I mean, this is what I say about 9 out of 10 times. When I say 9 out of 10, I'm not saying 10 different trades. Oftentimes, I'll be in the same trade for months, for at least, for weeks, if not months, if not quarters, right? Um, I don't know when the catalyst will happen. I just know that one will happen, and if it, and when it does, based on the information that I've put together, there will be a significant a revaluation of the stock, and that was what happened with GameStop. That happened with Revlon. That happened with Tupperware. That happened with Bed Bath and Beyond. That happened with Express. I have options right now on certain situations that are very similar to those situations. There are going to be, by the way, guys, there are going to be some really good situations, some really good setups in tech around some tech companies. Um,
Yeah,
again,
look, O'Hara, I want to keep it confined to the book. I know you didn't read it, so just for the sake of
yeah.
the
Well,
conversation, I don't want to
yeah,
get
yeah,
too
yeah,
far astray.
yeah,
Um,
yeah. But as
so
far as
so
the
so
luck
let
goes,
me
you
let me
did.
shift. Yeah, let me
Go ahead.
shift. Then I think we beat luck to a dead horse. I thought chapter three was actually pretty interesting. The title is Never Enough, and I guess the way to summarize it would be if you've ever wondered why objectively rich people risk everything to engage in illicit money games, then this is a fun chapter. And Housel explores the concept of what is enough when it comes to money. Why are some unsatisfied when they seem to have all the money they could ever need? Abe left the room, but he made a comment about professional investors, traders, whatever you want to characterize them as, speculating in 0 day to expiry, right? That I guess is a little bit of a corollary to this, but it gets back to right, like a lot of these millionaires and billionaires, they're looking at the millionaire or billionaire next to them, and they're comparing themselves to that, and there's this social comparison problem that is existential, I guess, as part of our society. It seems where we're looking at the car in the driveway down the street. We're looking at the house. We're trying to compare to these outward things, which don't inform us anything about the person's character, their genuine wealth. It's just these displays of richness, I guess. And I guess the question is like, how do you guard against those sorts of things? I mean, look, I'll be quite honest. Those things are meaningless to me. I don't care about it. I've been honest. I'll continue to shop at Walmart. I could be worth $1 billion, and I will continue to be frugal. That's just me, my very nature. But it seems like there's a lot of susceptibility in our society to these things like lifestyle creep that just creates this endless cycle where people are trying to get the bigger and better and more expensive thing. Like, I guess my question would be like, how do you guard against things like lifestyle creep?
Quit Instagram. No,
you
well,
mean you mean those Lambos aren't real, and I shouldn't expect everyone to have Lambos at 30?
well, I guess I want to ask you, Rod, then. You just mentioned that you don't care about those things. Like, how do you keep yourself, like, how do you kill your ego? How do you make sure that you're not comparing with other people? Maybe because I know a lot of people
Invest in
that do, right?
PLBY. That was a really good way to kill my ego. No, I mean, look, I guess it's just a nature of kind of at heart being like a value-oriented investor. I'm not going to buy ostentatious things for the sake of it. I just haven't been built that way. And even when I lived in Miami and saw it all around me, it didn't personally affect me and make me feel like I needed to do what those people were doing. But clearly, it's very powerful across our society writ large. So even if I'm maybe personally like a hyper rational person that that doesn't get sucked as much into these things, on the other hand, I got sucked into the NFT craze, and I certainly spent money in a fool's errand there. So even if I like to say for the most part I'm rational, I think we're all susceptible to these things to an extent, and I think just trying to recognize them for what they are is probably the easiest way to combat it. But I don't know. What do you guys think?
For me, it was interesting because after GameStop had happened and I made several millions of dollars, like when that happened, my desire to purchase things actually went down. It's just like I just had, and the what's his name? Morgan, he talks about this in the book, like how there's a difference between richness and wealth, right? Rich is about having the money and buying nice things, buying a
Yeah.
Lamborghini, buying a house, or
It's
house is a
chapter
good
9.
investment.
Wealth is what
Is
you
that
don't see.
yeah, yeah, yeah. And then wealth is the vacations that you could have taken but you didn't take. It's the money that you could have purchased a car but you just decided to ride your current car. So I thought like I could really resonate with that chapter. Like I felt once I had the money that I didn't have before, I just thought about how can I keep this? How can I build wealth more? How can I make more money? Rather than, oh, like I want to buy nice things and show off. Like I don't need to show off. I already have it, right? Like I think at least that's how I felt. I don't know about, other people, but
So yeah, let me read a couple quotes from that chapter because that is a good one. So Housel says, quote, "Rich is a current income. Wealth is hidden. It's income not spent. Spending money to show people how much money you have is the fastest way to lose money." And third one I put down was the only way to be wealthy is to not spend the money that you do have. It's not just the only way to accumulate wealth, it's the very definition of wealth. We should be careful to define the difference between wealthy and rich. It is more than semantics. Not knowing the difference is a source of countless poor money decisions. So I would agree though. Like I spent the most money I spent was on a cruise with my girlfriend, which we spent. I would have found it unfathomable to spend over $10,000 on a travel expenditure preceding that. So I clearly upped the amount I was willing to spend in that case. But other than that, I bought a new laptop. So like these were more functional, I guess, things. A vacation, a laptop that I still use as my daily MacBook. But yeah, like I don't know. I think that the distinction though between wealth and rich is definitely a good one, right? There's so
well,
many people out there that are levered to the tits and are spending money they don't have. Like what is his name? Ron Perlman. Revlon finally gone bankrupt, and
yeah.
he was levered for many decades. And I was like, what more did you need, buddy? Like, why wasn't that enough
Well,
for you?
listen, he
And
walked away with a lot of money off that deal. But anyway, I would say this, guys, for young guys, don't compare yourself to the next guy. Okay, do what you guys were talking about. Do what's right for you, but treat yourself. Listen, this idea of just hoarding money. I listen. I have a lot of very wealthy clients. Some of them are very happy. Most are not happy at all because they're always chasing more and more and more. And the people that are happiest have a balance. So I would say to you guys, if you have wins, take some money, treat yourself, go on a vacation, buy an asset that you're happy with. Buying a car is not a good asset, but buy if you've been pining for for that fancy piece of jewelry or a house or a condominium or it's okay to treat yourself from time to time. I would say use a general rule, maybe like take 10% of the money and pay yourself, put it away, buy yourself something nice. That way you have a feeling of accomplishment. It's not just money in a bank or a brokerage account that you're going to just dunk off on some other next new trader idea. You know what I mean? So it's okay to spend money within reason. It allows you that sense of like accomplishment, right? And there are good things you can buy with your newfound investment wealth, and there are bad things you can buy. So stick to the good things, and I think you'll be absolutely fine. And Rod, to your point about the vacation, that's fantastic. Vacations are great, dude. Believe me, it's those memories when you're an old man someday, and you're gonna remember those things. That's all you're gonna have when you're 80 years old. You know what I mean?
Yeah, it is. On the other end of the spectrum, the people that have uh, saved every penny for their entire life. I do hear this, your example of maybe a client who they don't spend anything, and that does kind of defeat the purpose, right? The purpose of acquiring these financial assets is not to just have more and more and more. I think the purpose is, and I'll shift us to chapter 7. The title is freedom, and it's specifically saying money isn't going to buy you happiness, but more freedom in your life. And a lot of wealth can bring you that freedom in your life, that freedom to wake up and decide, I can do whatever I want. I can quit the job I don't like and go do something else. I can only work with people I like working with. So I think chapter 7 actually is very much in line with that. And I don't know. I really like that one. Any thoughts, Joe, Han, JP?
And he does talk about how materialistic purchases, you should be very neutral about them because at the end of the day, you buy the car that you want to buy and you reward yourself. The satisfaction that you get from that is very short-lived. You'll be happy for a month and then you're going to want a new car, right? So it's like the materialistic thing in your brain, you should be thinking, oh, they're just neutral things. They'll make me happy temporarily, but it's not going to be permanent happiness. And he kind of talks about how you should be focused more on the freedom aspect of what the money can bring to your life. And I really agree with him there. And I can speak to that from my past experience as well. Like, no materialistic things have ever made me that happy. Although, if it's there and somebody gives me a nice luxury bag or whatever, like, not that I care about bags, but like whatever it may be, like, I'll be like, oh, sweet, like, that's cool. But it's not going to make me happy. And I think a lot of people are like, oh, if and when I get money, I'll be happy. If and when XYZ happens, I'll be happy. People shouldn't be putting contingencies to their happiness with, especially like materialistic things. So I thought it was a good chapter.
I think it's all about finding a middle ground. Obviously, people that don't have money think money will solve all their problems, and then, maybe one day they get money and they realize that's not quite true. Um, for me, I just appreciate the experiences that money can open up. The ability to travel someplace that you wouldn't have otherwise been able to travel, live these experiences. Obviously, I've traveled the country in a Sprinter van now several times, and although that isn't really super expensive. You can get a van pretty cheap, but it's definitely something that I appreciate spending my money on more than I appreciate spending it on some luxury goods. So definitely depends how you spend the money on whether or not it brings you any sort of happiness. For me, it's all about like just kind of trying to live life to the
Yeah.
fullest and seeing as much
You
as
know
I
what I would
can.
say too,
And
guys? Spend if you're going to spend money, spend money on your intellectual endeavors and on your health. Eat better, right? If you can afford to now eat better, do it, right? Eat better. If you can afford to go to build yourself a home gym or go to a really nice gym and have a physical trainer, do those types of things. You know what I mean? Treat yourself, right? Your health, your body, your mind.
An investment in yourself
Truth.
is absolutely never a bad decision. 100% agree, O'Hare. Um, Speaking of, I guess then let's go back to that kind of compounding chapter because I think a lot of people, you made the point over here that compound interest is such a powerful force and we take it for granted. And uh, in this chapter, a couple quotes that jumped out, right? If you want to do better as an investor, the single most powerful thing you can do is increase your time horizon. Time is the most powerful force in investing. Another quote, good investing isn't necessarily about earning the highest returns because the highest returns tend to be one-off hits that can't be repeated. It's about earning pretty good returns that you can stick with and which can be repeated for the longest period of time. That's when compounding runs wild. We talked about Buffett earlier as an example. I mean, I'll ask this question, for folks maybe who started investing, later, and I don't know if folks in the panel, align one for one with this, but the question would be like, what are some things you would say, to a younger version of yourself, whether it's in your teens or 20 or 20s, whatever, what would you say now to your younger investing self, that you would recommend or you would advise?
I I would say that's a great question. I would say to myself, and I've thought about this, and I have two. By the way, I have two young boys, or young. I have one kid in college now, a freshman in college. He's 19, and then I have a sophomore in high school. And we talk about these things, when we're together. And I guess the number one thing I would have done differently. I for myself, I would have stopped spending money on stupid shit. When you're young, you have a tendency. I was making good money. I was making a lot of money. I was making more money than I ever thought I would when I was younger, and I spent money like I was making money, right? So I would have taken a few steps back and started saving earlier. Started investing, not trading, investing earlier. Because I had the investing, or I had the trading itch. I worked on the options floor in San Francisco. I was surrounded by guys trading options all day long. That's what we did. So I think, to answer your question, for myself, I would have started earlier investing for the long term, right? As I've gotten older, I understand that. When you're young, the old saying, young, dumb, and full of cum, you don't kind of think about,
The
the
long term
future.
might just be next weekend if you're young
Exactly. That's
and in the
exactly
party
right.
mood, right?
Oh, absolutely. And listen, in San Francisco in the late '90s, I can just tell you guys, dude, almost every night we'd be going out, sushi, bottle service, Friday nights, Saturday nights, going to the clubs, having our own section with bottle service. I mean, you're dropping, 4 or 5 grand, 6 grand, more, depending on how many people are, every night you're doing that. And then I think about how much money we spent doing that kind of stupid shit, that was just fleeting, right? And then you wake up feeling shitty the next day anyway, and you're like, and then you do it anyway, right? And so this is what happens when you're young. You don't really think about, you're thinking for now, not for tomorrow, right? You're thinking about, how am I going to have fun today? I don't care what happens a week from now. So you're right. So I think for me, I'm 47 years old. I would have spent less money on stupid shit and started investing for the long term. I think that for me, that's what I would have done. And I can't take that back. That's why every chance I get talking with younger people, including my boys, I try to instill that in them. Of course, it's very difficult because they're like, Dad, what do you know? I want to party. They're just like me. They're just like everybody else, when they're that age. You know what I mean?
Well, you didn't know me. I was maxing my Roth when I was a teenager. I don't really fit into the normal mold, I guess. I actually don't know what I would tell my younger self to do differently. Maybe I would tell myself to spend more money, to be quite honest. I'm probably on the other end of the spectrum from most. I was always very like manic about maximizing how much interest I could earn on savings accounts and different card and bank sign-up bonuses and the like. And
And I think it's also a function, Rod. I think you bring up an interesting point here. It's a function of your experience as a young person. My experience was, I immigrated from Eastern Europe at a very young age, with my parents, and my parents were both electrical engineers, very smart people, college educated. But I saw my parents struggle. They never really had a lot of money, right? They never had that financial freedom, because they started out. You imagine moving to a foreign country with 2 kids and starting over. I mean, it's a very difficult thing, very difficult choice. It worked out for their kids like me. It just didn't work out for them necessarily, in the way that they, I think, imagined. And so my life as growing up was, I didn't have money. I didn't have an allowance. I had to work. And so when I started making my own money, I went fucking apeshit. I went wild. I was like, fuck, I'm making all this money. I was doing things I didn't think I would be able to do. And so you, on the other hand, had a different upbringing, different childhood, right? Upper middle class, suburban. I think it's so. Everybody is a little bit different in the way they think about money. They think about spending money, but based on kind of their upbringing. And I think you touched on that earlier. So, you know, it's not my fault and it's not your fault. It just is, right? It's just the way things are. And by the way, the best way to learn is from someone else's mistakes, right? People always say you should learn from your own mistakes, and I agree 100%. Learn from your own mistakes. But I always one up people and say, look, you should also learn from other people's mistakes. Those are the cheapest ones, right? Those are the best lessons. They're the ones that someone else fucked up and you learn from their experience. It's harder because you've got, unless you've been in those shoes, it's hard. But learn from other people's mistakes. I think that I think is really critical.
Yeah, for sure. And that's actually like a really good, it's a good segue for chapter 10 because chapter 10 literally is called Save Money. And one of my favorite part about that chapter is like we work endless hours to gain like 1 to 3% gains on investments. But if you just save and spend less, you can, pretty much pretend as if you made that 1 to 3%. So it's savings a very big part in investing. But I would like to
yeah,
encourage the participants, like other people, to also engage. If you guys have good experience or anything like that, doesn't matter your investment knowledge or experience, everybody's more than
yeah, for
welcome to
sure.
raise their hands. Yeah, we'd love
For
to
sure. I
hear
think
from
this
you
is a good
guys.
one. This is a good chapter. Chapter 10 is a great one, I think, for anyone across the spectrum to hopefully chime in if they'd like. So, a couple quotes from it that I jotted down in my notes. Quote, building wealth has little to do with your income or investment returns and lots to do with your savings rate. Less ego, more wealth. Saving money is the gap between your ego and your income, and wealth is what you don't see. So I had a question that I was going to pose, and I'll I can answer it, or maybe Joe, Han, JP, O'Hare, or if someone else wants to put their hand up as a speaker. So I guess the question was, how much of your income do you dedicate to savings, and how do you think about the trade-off between saving and spending? Yeah, I'll just again share. I guess my experience was always that to me, saving was literally like one of the first things that I had to do with any money I was earning. Had my first job when I was 12 years old, refereeing youth sports, and my I guess I just was always programmed from a very young age. The first thing to do with money you make is to ensure that you save a portion of it. So for me, it was just something instilled at a very young age. That you should be paying yourself first. You should be saving money first before you then look to spend it. It shouldn't be that you save what's left after you spend. Otherwise, if you have bad spending habits, you're gonna very readily find yourself spending down to the last penny, which a lot of people do, and it's people all across the income spectrum, right? It's people with six-figure incomes that live paycheck to paycheck because they find themselves spending more money for whatever reason that they then they don't put saving themselves for themselves first. So like I guess that's just I think an important mentality, and we always talk about trading and investing in these spaces, but really just saving money, like it's so vital to just prioritize that if you can. And obviously the question of how to think about the trade-off, right? Everyone's situation is very different. If you're a young, teenage kid who doesn't have to pay rent or pay a mortgage, your ability to save those incremental dollars is very different than maybe someone who's bringing up a young family who has exorbitant expenses related to that. So then though it's like, well, you still need to save for both yourself, because if you're not positioning yourself to be in a good spot, how are you going to be able to take care of the other people in your life, your family, your friends? So like, I don't know, I just always go back to that importance of paying yourself first. I'm sure on a percent basis for me, it's probably north of 30-40%, which is probably more than it needs to be. Um, but I'm trying to get better about spending money. Believe me, I am. Like O'Hare, I 100% agree. Travel is a fantastic way. A lot of my millennial peers are big fans of spending money on experiences. I am also a big fan of experiences being a good investment in yourself to enrich your life. But just has to be, I think, a mentality where saving is like it comes right next to paying the rent or paying your mortgage. You pay the bills you have to pay, and then saving is a bill you have to pay.
Yeah, I'm with you on that. It's tough. I mean, I'm 23. I'm going to be 24 tomorrow, and I'd say almost everyone my age that I'm surrounded by is not saving anything. I mean, yeah, you ask them and they're like, "Oh yeah, I got to make rent this month," or "Oh yeah, I don't know if I can really afford to go out with you guys." And for that reason alone, I try to hang out with a little different demographic. But still, it's crazy to me to hear that. And granted, I've been blessed. I've had a lot of fortune in my life, but I've still not been spending that. Like, b- incredibly lucky with GameStop back in January 2021, and that's still money that I keep in my brokerage. I don't spend that money on it at all. I've never spent it. I had paid my taxes, and then that's it. And it's for me, it's a nest egg, and it's something I plan on compounding over the years, and not spending on anything lavish. And most people my age probably would have went and bought a super nice car or something like that. And for me, it just doesn't bring me any joy. So it is a bit of a frustrating thing to hear people that really are struggling quite a bit. and then seeing what they spend their money on, whether or not it's going out drinking every weekend or going partying or going to too many concerts or things like that. And it's not for me.
Right. Yeah, I definitely can relate to Joe. A lot of people around me as well. Their saving is not their priority, and I think this trend gets worse in the younger generation as well. And this presents an interesting kind of opportunity for people who are, more savvy. People like us talking about this book on Twitter. We understand that saving can be a powerful tool in the future in our investing career, and frugality can give us power. So, kind of understanding and embracing that concept gives us the power to advance ourselves and have an edge over all of our peers who are less focused on saving, which will help us in the long run.
The way that I saved was like I always thought about money kind of as like a game, and like it's just like a computer game, and like the numbers keeps going up, and I want to make sure it keeps going up instead of using those points. So I was so extreme to a point where like I had an Airbnb business, and I still do it. I've been doing it for like 7 years. I have several properties that I manage, and I was so frugal to a point where I made a room on the fourth floor and rent it, and it's like a tiny ass room with like doesn't even have a proper bed. I bought like a floor bed from Amazon for like $70, and I would Airbnb every single room. Like, of course, I could live a normal life. I could have my own room, and I had a great job. Like, so but I don't care about those things. I just focus on making sure that the numbers on the game on my screen keeps going up. Like for me, like I live as if I make like, the lower echelon of, salary, right? So I never want to think that I have money. I always think I'm like I don't have enough, and that's how I should live if I really want to make wealth. So that's kind of like helped me save as much as I can. I try to think about how much money I spend on a grocery store. Just because my wealth went up doesn't mean that I should be buying everything that's more expensive, because that goes back to the chapter from previously about rich versus wealth. And yeah, I think we should be focusing on growing our wealth and saving as much as we can.
I agree with you. Looking at my portfolio balance and thinking of it as like a high score, like a ping pong
Yeah.
game. And it's like funny because then you can go spend that money on whatever you want. But I'd literally rather just see a higher number on a screen.
I
It's
honestly
kind of funny.
consider
But
that
then the
money not even
pushback, right,
matter.
would
I
be
don't even think
that
that it's
you,
there.
yeah.
Yeah.
I mean, I get it. I'm like very much with you guys that I much prefer line go up than line go down. But I think that's where it'd be the balance, right? Where you should be able to realize that freedom, so that if you want to spend some money, here or there, you're free to do so, but you're not beholden to, using debt as an instrument to fund it. And it's just about balance, right? I mean, that's what it boils down to.
I think you like for me, like training what my balance is where the effort comes in. Like it depends what your standard is that you consider what to be balanced, right? But if my balance and my standards are much lower, then I don't feel like I'm sacrificing a lot. I feel like I'm living a normal life. So I think you
Well,
just,
that goes to like chapter 11, right? With your
yeah.
reasonable versus rational. Something that's reasonable is going to work a lot better for somebody in achieving that balance in their investments and their spending and their life than trying to find some like hardcore book that tells you can make this much money in this period of time if you do these three things. And I think that's where you're going to go awry if you try to religiously follow some manual, as opposed to find these general themes that make sense, adhere to them, find what works for you, live with balance. Um, that seems like a better strategy for most than
It
yeah.
is, but I think we should be training ourselves. Like because for me, I don't think I got to where I got to just by reading it in the book or anything like that. I've experienced it. I faced it head on. I've lost a bunch of money, and after losing that money, I realized the value of money and start having my own philosophy regarding it. And I think that reading these books helps you not make mistakes and we should learn from other people's mistake, but at the same time, there's definitely like lessons that you do learn throughout the process, and we shouldn't be afraid to face them head on. And what that really gets you is the threshold and your what quote unquote balance and standards, right? So I think it's not just given to you. I think it's earned, and you need experience as much as you can.
So we're touching on a lot of different topics here, and certainly anyone who's listening, if you want to share your perspective on any of them, feel free. Um, JP, what chapter have we not touched on that we should go into? I think the savings one is great. I mean, that's
Saving
just
one's good. Yeah. I
it's
think,
so like underappreciated.
yeah. What do you think about chapter five? I thought chapter five was really good because, it's not about just making the
Mm,
money. Like making the money is one thing, but the just as important is to maintain that
yeah,
money and survival. And
yeah.
what do you think about that
Yeah. I
chapter?
think
Yeah.
that's a good one because it's kind of fine. This is the, I guess, perspective. The chapter's titled "Getting Wealthy versus Staying Wealthy," and Housel notes that in his view, staying wealthy is more tricky than getting wealthy. Um, how can you keep the wealth you've accumulated? And there's a couple quotes in there. So getting money requires taking risks, being optimistic, and putting yourself out there. But keeping money requires the opposite of taking risk. It requires humility and fear that what you've made can be taken away from you just as fast. It requires frugality and an acceptance that at least some of what you've made is attributable to luck. So past success can't be relied on to repeat indefinitely. And also, planning is important, but the most important part of every plan is to plan on the plan not going according to plan. Many bets fail not because they were wrong, but because they were mostly right in a situation that required things to be exactly right. Our options are a good example of that. Room for error, often called margin of safety, is one of the most underappreciated forces in finance. It comes in many forms: a frugal budget, flexible thinking, and a loose timeline. Anything that lets you live happily with a range of outcomes. So I had posed the question, or I was going to pose the question, if you've been fortunate enough to find yourself on the other side of this, where you've reached the getting wealthy part, what steps are you taking to retain accumulated wealth and to be part of the staying wealthy? I mean, I know, O'Hare noted that so obviously plenty of people made a lot of money and also lost a lot of money in the meme mania that is most famously, I guess, characterized by the last week of January 2021. And it's definitely something I've given a whole lot of thought about because the outcome was very much a tail outcome, a favorable tail outcome for me personally. So looking at the wealth that had been accumulated, it's very much present in my mind. Like that was easy come, that could be easy go. So I think you've heard me talk a little bit about how I personally think about money to an extent. So it's maybe a little easier for me. I'm inherently a more of a value investor at heart, more of a margin of safety investor. So I'm not personally taking like crazy risks to try and keep up with the Joneses. I think that paranoia is definitely present in my thinking. The idea that if you make some catastrophic mistake, I mean, I made a poor mistake with PLBY, right? And I noted extensively on Twitter, on social media, my personal account. The unrealized loss is literally multiples of my annual income, which is horrible. It was a very poor investment decision that I made. So can't make too many more of those if I want to retain my accumulated wealth. But it's a reminder, you need to size things appropriately. You need to understand that, when you're thinking about the upside, you need to also think long and hard about the downside with these things. So you just if you have a windfall, you shouldn't expect that you're going to continue to have windfall gains, or that luck will continue to ride on your side. So I guess it's a little bit of that humility and paranoia, which I wish I had more of coming out of January 21's mania with hindsight.
think we covered most of the most important chapters. What do you think? Is there any other chapters that we want to cover? Han, Joe, Rod?
How many chapters in this book? How big is this book?
It's a quick read, actually. It's a very easy read as well. I
Is it?
think everybody should definitely pick
Okay.
this up. I mean, there's 18, I mean, technically there's 20 chapters, I think, but there's only 18 chapters that are like actual
Not even
lessons.
200 pages.
Yeah, and
Oh, okay.
just super.
What's the story of this? Can you give? Like I said, when I hopped in, I've never read this book. I've read similar books, but what is the story about the author? What's his background?
You know, it's funny. When you read the last chapter, he kind of notes that he's just a passive investor. So he does not do any active investing. He's a partner at a fund, and the author of the book. He was a Motley Fool and Wall Street Journal columnist, but
Okay.
And he also
he
started as active
definitely
investment
writes
banking,
in a
right?
very easy to understand manner, and he got good feedback from folks like Howard Marks, Jason Zweig. A lot of like prominent writers and finance thinkers had good things to say. I think it's a worthy read for anyone, regardless of your competency level. Um, but
And actually, I think it's a good read for people. Even I think I was just thinking about what you were just saying there. Uh, it sounds like a great read for people just getting going, because if if you get lucky like you did, and this is what I love about the stock market, guys, there's a new opportunity tomorrow somewhere. You just have to be smart enough to go find it, right? There's always opportunities. So for those people that have not yet been as fortunate, and they happen to get fortunate because of their hard work and diligence and uncovering some new opportunity, reading a book like this prior to having that is probably very critical, right? So maybe to your point, get the book, read it, even if you haven't experienced a lot of success in investing and or wealth, right? Because this way it'll prepare you better, right? So when you do inevitably get there, with perseverance and stick to itiveness, you're not going to be blindsided, right? You're gonna be better prepared for that success. Maybe, by the way, that question you asked earlier, what we could have done, kind of earlier in our life. I would say that's the answer would be maybe I wish I would have had an opportunity to read a book like that, right? As a 20, 22, 23-year-old guy, 25-year-old guy. You know what I mean? As a younger person, maybe having the opportunity to read a book like that early on.
yeah, absolutely. Okay, we've been going about an hour and a half, so I haven't seen anyone else request to come up and speak. If anyone does want to touch on any of the chapters or topics, please don't hesitate to do so. We'll probably wrap up on, let's see, I guess, we could wrap up on the last chapter, which is when you'll believe anything. I think that that's maybe an interesting one to end on because we've been in a very narrative-driven world. It seems the last several years as we've been in this post-COVID era. Um, so the chapter is when you'll believe anything, and a couple quotes I picked out of it, and I'll get to the question I would pose before we wrap. So, quote, the more you want something to be true, the more likely you are to believe a story that overestimates the odds of it being true. I think we could largely all agree with that one. If you want something to be the case and you're reading about it,
That sounds like a lot of the conspiracy spaces on Twitter.
oh geez, yeah.
Nate,
Oh boy. Slightly positive adjusted EBITDA is not a thriving business, but we won't go down that rabbit hole today. Um, quote, wanting to believe that we are in control is an emotional itch that needs to be scratched rather than an analytical problem to be calculated and solved. The illusion of control is more persuasive than the reality of uncertainty. So we cling to stories about outcomes being in our control. I think that really goes back to what we, talked about with the chapter about luck and risk, a few of the other things here. You do things right on a long enough time frame, enough times, just like the poker example. If you're making the right plays over a long duration, over multiple rounds of the game, you're much more likely to win than if you get all the way down to a one-time scenario, because it's very easy to overweight that one outcome than to really try to step back and think about the importance of the overall repeatability, I guess, of things. So the question I would pose before we wrap is, what are some examples of ways that you've deluded yourself through an easy narrative? I'll go first. We talked about, I mentioned a couple times in this call, PLDY, which is formerly Playboy. They have a couple other brand assets that they own today, but I believed very strongly, and incorrectly so, that they would be well positioned with their brand assets to meaningfully grow their direct to consumer business. And I thought all about the upside and of the oodles of riches that could be realized if they were successful, without giving nearly enough weight or spending nearly enough time on what happens if they're incapable of executing on any of these initiatives, which unfortunately the execution has been below my lowest expectations, hence the stock trading at $2.10. So, I bought into a narrative that was pitched by management, right? All of these management teams are pitching a narrative. They're, if you're reading an investor deck, any investor deck, unless it's like maybe a very select group of like blue chip corporations, those are sales documents that are intended to entice you and show you the good and not show you the bad. So, as investors, I think that it's very easy for us to delude ourselves if we're not careful and we're not thinking first and foremost about preservation of capital and margin of safety when we're allocating our capital in our investments. So for others, what are maybe some ways you feel that you've deluded yourself through an easy narrative? You guys never deluded yourselves into believing something?
For me, I bought this NFT and I thought it would just keep going up, and obviously I was wrong. And I was like, oh my gosh, like I got this like super rare because I bought it before like the release. So it was like, it was like $150,000 at the time. And then it went all the way down to I think like $4,000 before my girlfriend's wallet got hacked and my ape got stolen. But yeah.
Oh, man.
JP, what about ATOS?
ATOS, yeah, that was pretty crazy. Obviously, I lost a significant chunk, down 1.5 mil on that investment. And, but I got pretty unlucky with what's that guy's name? The guy who backstabbed us. What's that guy's name? Or whatever. Let's not call him out, whatever. But yeah, I had some bad turn of events and I had high hopes and in that hopium and hoping things work out. But yeah, just that's part of the game too. So
The commonalities, we're always thinking about the good and the profit and the positive outcomes, and we're just not spending enough time thinking about the negative likelihoods and the downside. I
yeah,
think that for any of these stories, that's probably a consistent theme.
yeah,
But
exactly.
again, we as humans, we tell ourselves these narratives to fit these worldviews that we hold, and they can be bad, right? If we're incorrect in the narrative we're telling ourselves, if we've made our personality that of a perma bear doomer, it's going to be difficult for us to make a good long-term investments if that is the narrative we're preaching, that the world is coming to an end, at any time now, right? But like some people have been saying since 2009, and eventually they may be right that there will be a very tragic, catastrophe. But Yeah,
It,
that's another chapter, the seduction of pessimism, but not to open up another can of worms.
yeah, and just to add one more point, I still haven't lost hope for ATOS. I will not sell, and I will never sell that position.
Oh boy. All right. Well, look, it's 9:36. I think we're gonna wrap it there. So really appreciate people tuning in. O'Hare, thank you for joining, and Ape, who's not here, but thank you for being a speaker as well. Very much appreciate the perspectives. We hope that you enjoyed the discussion around the book. I do highly recommend the book for sure. It's probably most beneficial if it's for someone a younger investor or earlier in their investing journey to read this. But I do think even if you're farther along your journey, it's still good. There's some really good one-liners. That's probably the best part of it is some really well phrased, concise wisdom in there. O'Hare, did you want to chime in?
No, I just want to say, good space, man. You guys always run some really insightful spaces. So it's just a shame that more people don't come in here. I noticed I was at the gym getting a workout while I was in here with you guys. I love the topic and I love the discussion. A lot of good insight. Just a shame that more people don't come into spaces like this and share and learn. We got these other spaces running all day long, talking about nonsense that can't be, that most people aren't going to apply. But it's just weird. Human nature is so
Well,
strange,
yeah,
It's
we
just
definitely
I don't.
get it, right? It's much more fun for a combative, hysterical type discussion from a drawing in the eyes and ears. Unfortunately, we don't do too many of those. But that said, I will say we are looking forward to where I'll host these kind of bull versus bear discussions so that we can get a little bit more of that. Maybe I don't want to say adversarial, but at least get some viewpoints that are on other ends of the spectrum on some different stocks going. So that's in our to do. That's coming soon. Just other programming note, this is the last Tuesday of the month. We anticipate continuing to do these book club discussions on the last Tuesday of every month at 8 o'clock Eastern time. So
What's the next book, by the way?
we are going to send out on Friday in our Wook and Review newsletter, which if you don't receive it, it's free. There's never going to be a charge for this. The link is in the Wook Capital profile. If you just click my profile right here at Wook Capital, there's a little newsletter, .wook.gg, that'll bring you to the link.
I'll check it
Yeah,
out.
you can get that. We send that out at 9 a.m. on Fridays, and then at 4 p.m. every Friday, we host the Spaces discussion to kind of recap some of the major economic and market related and stock related events of the week. So we do that every Friday at 4. And then tomorrow night, we'll have our open mic spaces. So O'Hare, I hope if you're free and others, we do that at 7 p.m. on Wednesdays. Joe and I host it on my personal account. So,
Yeah, I've been on. That's Wednesday nights. I've been on
yep.
those. Those are fun. Yeah, you do a good job with those.
Thank you.
Excellent.
Thank you. So again, look, the thesis behind Wook Capital in essence is that you can realize investment alpha through crowdsourced research. And that we talked a little bit about that experience with GameStop, tonight. We certainly welcome you to check out Wook Capital in our Discord server. Join our conversations, wook.gg. And just engage with us on social media. We're a private investment fund. We have no intention of ever selling any products or services to people. We are not managing external capital. We don't have any need to do that. So we very much look forward simply to growing as investors, identifying unique opportunities, and hopefully being able to share our research over time. So thank you very much for joining in our third edition of the Wook Book Club, our discussion on the psychology of money. And we look forward to engaging with you soon. So cheers, everybody. Have a good evening.